everyone, and welcome back. We are going to start on chapter 4 today. The first few chapters have gone through a lot of information and very general information about accounting practices, generally accepted accounting practices. So, a lot of that information you've already learned is what we're going to use in chapters 4 through 8 or 9, depending on how quickly we can travel through here. But you'll be using those practices you've already learned: debits and credits, preparing financial statements, adjusting and closing entries. So let's get started on chapter 4. It's all about merchandising companies. So far, we've been talking about service organizations that sell time to earn revenue, whether they be a consulting agency, a plumber, a mechanic, where you sold time, not merchandise. This chapter and the next chapter, where we talk about inventory, we're specifically talking about merchandising degrees. So, you know, in a service company that you have revenues minus expenses equals your net income. That's the business, that's the process. There we go. But a merchandiser earns net income by buying and selling merchandise. So we've got the cost of those goods in there that they've purchased, and we have to figure that into the equation. So we start out with net sales, not revenue. Net sales minus the cost of goods sold equals gross profit. Remember that word, gross profit. Then you subtract expenses. Those expenses you already understand, like rent, utilities, cleaning costs, and then you subtract the expenses and they equal net income. So you're just adding in the deduction of cost of goods sold equals your gross profit, then your expenses and net income. I'm pretty sure you already understand how the income statement's going to look different, because you're going to have the net sales, less inventory, less cost of goods sold, gross profit, and then you go on to expenses and net income. If I learn to use PowerPoint, it'll work out fine. You also know that with merchandise, there's usually more than one person in the middle. You have a manufacturer, you have a wholesaler, you have a catalog, you have a retailer, and you have a consumer. So there are various ways. You're going to learn later in this chapter that normally a merchandiser is both the or the company who purchases it, can't even talk today, the person who purchases the product. It also is the company that sells the product. So, for instance, if you owned a bike shop, you would purchase bicycles from a manufacturer or a wholesaler. You would hold them in your inventory, and then you would sell them to a consumer. So there's two different kinds of accounting entries that you're going to need to learn to make. The one set of accounting entries is when you purchase the items, and then the other set of accounting entries is when you sell the items. And right in the middle, we have inventory control, and that's chapter 5. So chapters 4 and 5 are all about merchandising. Let's get through chapter 4, help you have a good understanding of that, and then you can move on to chapter 5 next week. All right, so we've already talked about reporting the income for a merchandiser. They sell products to earn revenue: sporting goods, clothing, auto parts, groceries, shoes, bicycles, office supplies, just about anything, tables, chairs, audiovisual equipment. They're all merchandisers. Any store, either a brick and mortar store or an online store that you go to, is a merchandiser. Okay, so let's talk about their path and their financial equations. Merchandiser has net sales minus cost of goods sold equals the gross profit minus other operating expenses equals their net income, or net loss if the expenses and cost of goods sold are greater than their revenue. So this is how their income statement would look. Z-Mart Corporation income statement for year ended December 31st, 2015. Make sure you're always getting those financial statements titled correctly. You have your net sales, cost of goods sold, gross profit. Then you have your regular operating expenses, less those expenses, and the net income or net loss, depending on whether they spent too much money or not. The operating cycle for a merchandiser begins with them purchasing the merchandise, bicycles. They may sell items on credit or they may collect cash. So if they sell bicycles on credit, they have accounts receivable. You know that's an asset. If they sell it for cash, they collect the cash, which is an asset. And always remember that merchandise inventory is an asset as well. So with inventory systems, and like I said in Chapter 5, we're going to learn about those inventory systems. So you start with the beginning inventory, you add all of your purchases, and that equals merchandise available for sale. That is a very important term during the next 2 chapters, is merchandise available for sale. And then once you get to the end of your period, whatever it is, you have an ending inventory and you have cost of goods sold. Ending inventory is what you still have in your inventory, in your store or in your storage. Cost of goods sold is what has gone out and been sold to the public during that time. So there's 2 different kinds of inventory systems. One is called a perpetual system, one is called a periodic system. The perpetual system is what most companies use now, and that has happened because of the ease and use of technology, of computers, of being able to track your inventory. With perpetual system, it is continually updating the records based on sales transactions. So every time Walmart gets a shipment in, those items are checked into their inventory, and then when you go through the checkout line and that number's scanned, it comes out of their inventory system. If there's a periodic system, which everyone used to be, accounting records are updated only at the end of the accounting period. Very few companies use that anymore because you can have an ongoing record of your merchandise. I will tell you that both systems, a perpetual system and a periodic system, almost always do an inventory, a physical count at the end of the year to account for shrinkage. Shrinkage includes theft, breakage, spoilage, anything that's happened that's made that inventory, it's either not there or it is not acceptable for sale anymore. So they will do an inventory. You've probably seen people in a grocery store or in Walmart or in a drugstore, a pharmacy, where they're walking around and putting tags. They're counting things, putting it into a machine and putting tags showing that's already been counted. So what they're doing is an inventory. They're probably a perpetual system, but perpetual systems do that inventory once a year to account for shrinkage. Okay, so we're going to start at the beginning and we're going to talk about merchandise purchases. It's simple. You guys have done this. On November 2nd, Z-Mart purchased $1,200 of merchandise inventory for cash. We're going to debit merchandise inventory, which is an asset account. We're going to credit cash, which is also an inventory account. We've dated it November 2nd. We've put our explanation there. It is a simple journal entry. You all know how to do that. You know how to post it to your ledger or T accounts. Within sales industry, merchandising, there's something called trade discounts. Trade discounts are those discounts that a business owner is given for various reasons. So let me give you some examples of trade discounts. A merchandiser looks at a catalog to order something, and it says if they order 100 or more, they're $10 each. If they order 200 or more, they're $9 each. And if they order 500 or more, they're $8 each. So that is a quantity discount when they order large quantities. There's also other reasons that companies will give you trade discounts. You're a good customer and you buy a lot from them. It's not quite the color you want, but you're willing to take it just because you think it'll sell, so they give you a little discount because it's not quite the right color. Or you want 900, but they have 1,000 in stock, and they tell you they'll give you a discount if you'll take the extra 100. So there's all kinds of ways that companies can negotiate trade discounts. But this is what an invoice looks like, and there's a few things on it that I want to point out. This is a source document, so this is what would come into your company when you receive the shipment. It shows the invoice date and number, who it was sold to, the address, the purchase order date, who the salesperson was. Terms, we're going to talk about terms in just a few minutes. That's the terms of paying your bill, and you get a discount if you pay it in a certain amount of time. FOB, where the freight on board is, whether it's shipper or destination, who the shipping company was, the cost of it. So most of this we're going to go through. We're definitely going to go through terms and the freight terms as well. All right, purchase discounts. When I just talked to you about FOB, look at number 5 where it says terms 210 net 30. That is your purchase terms. And purchase discount or your terms are what's deducted from the invoice granted to induce early payment of the amount due. So if you see a term that says 210 net 30, it's always the same. And oh, I found this fancy little button. I just want to say that one of my students told me how much they love the squeakiness of these markers on the glass, but there's not a thing in the world I can do that. So if your terms are 210 net 30, that's what it will look like on your invoice. And this means they will give you a 2% discount if paid in 10 days. Or you owe the entire amount in 30 days. Now, this is how it's always written, and everybody in retail and merchandising knows what this means. Exactly. If this changed, and it said 15.5 net 20, it would mean they get a 15% discount if paid in 5 days, and the entire amount is due in 20 days. It's called terms. It's a purchase discount, and it's due to entice people to pay their bills quickly. Companies want to get their money as quickly as they can. My husband and I had friends that owned a grocery store, and they were always behind in their bills. They could never pay their bills. They were always complaining about it. And so I said to them one day, "So what's your gross? How much do you spend every year on groceries?" And they said, "Oh, $1.5 million." But they didn't take any. They said they never got the groceries paid for, deliveries paid for within their discount period. And they never made any money, and they never had any profit, blah, 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 blah. And, the math is, though, if they had a 210 discount period and they purchased for their grocery store $1.5 million, at 2%, it would have been a $30,000 discount for them to just get their bills paid on time, but they got behind from the beginning and they never caught up. So these purchase discounts can be very, very lucrative for big companies. Big companies like Walmart, don't worry about them. They don't pay their bills for 45 to 60 to 90 days. But for small companies who need that little extra bit of income, they can actually make a little bit of extra profit if they'll just get their purchase terms in place and get it all paid on time. So that is what you need to know about purchase discounts. All right, let's move on. Okay, it's going to give you, we told you 210 net 30. So this is how it is recorded in a journal entry. On November 2nd, Zmart purchased $1,200 of merchandise. Inventory on account. Credit terms are 210 net 30. 2% of paid in 10 days. The full amount of paid within 30 days. Okay, so we've got merchandise inventory. Nothing changes here. November 2nd, debit merchandise inventory, $1,200. Credit accounts payable, $1,200. Purchase merchandise on credit. Invoice dated November 2nd, terms 210 net 30. Just a reminder that if you pay it within 10 days, you would get a discount here. Then, when the account is paid, let's go back there. You were increasing accounts payable, so you credited it. It's a liability account. When you paid it on November 12th, so it's within the 10 days, accounts payable are debited for the full $1,200. You take the $24, the 2%, that merchandise inventory, where we've reduced it, we've reduced the cost of our merchandise. So we credited merchandise inventory by 2%, which is $24, and we paid it with cash. Cash was just $1,176. A note in the note that you've explained that. So the cost of merchandise in a company is everything that it costs them to get it to the floor to sell. So if you have the cost of the merchandise, if you have a purchase return, if you have a discount, it comes off the cost of merchandise. If you pay shipping, it adds to the cost of merchandise. So all those different factors go into the cost of your merchandise. All right. This is what your ledger or T account would look like. Notice merchandise inventory has a November 2nd balance of $1,200. You credited the terms on November 12th. The balance is $1,176. Your accounts payable was $1,200, so you will debit accounts payable for $1,200, and you have a zero balance then in your accounts payable. Purchase returns and allowances. Purchase returns are returned to the purchaser, merchandise returned by the purchaser to the supplier. So if someone sends you merchandise that's not the quality you want, or they send too much, or it's not what you ordered, that's a return, and you send it back to the supplier. Purchase allowance is a reduction in the cost of defective or unacceptable merchandise, where you're the company purchasing it and you get it and it's not quite what you wanted, or it's not the quality you wanted, or it's not what you need, but you say, you know what, I can still sell this, but at a reduced price. So you keep it, but you negotiate an allowance or a cheaper price from the company that sold it to you. So let's look at how those transactions would look. On November 15th, Zmart issued a $300 debit memorandum for an allowance from Trex for defective merchandise. November 15th, accounts payable, $300. Merchandise inventory, $300. This is for the debit memorandum. This is where we returned the bad merchandise. So we took it out of accounts payable. We also took it out of the inventory account. Purchase returns and allowances. If we said that on Zmart purchased $1,000 of merchandise on June 1st with terms 210 net 60, which means you can take a 2% discount in 10 days and you pay the full amount within 60 days. 2 days later, Zmart returned $100 of goods before paying the invoice. When Zmart later pays on June 11th, which is within the 10 days, it takes the 2% discount only on the $900 remaining balance. You purchased $1,000, but you returned $100, so they're not going to let you have a discount on merchandise that you already returned. Okay, so on June 1st, merchandise inventory was $1,000, accounts payable was $1,000. Correct to note. On June 3rd, we returned $100, so we reduced $100 from accounts payable and we reduced $100 from our merchandise inventory. And then on the 11th, when we paid it, our accounts payable was $900 now because we had returned $100, and our credit is merchandise inventory for $18 and cash for $882. So I think if you'll just look through that, it makes sense. Remember what your asset accounts are. Make sure you know that accounts payable is a liability account, how you're reducing them. Make sure you're keeping your accounting equation in balance, and just keep all that in mind. All right, the next thing we need to talk about is transportation. I told you that the cost of transportation is part of the cost of the merchandise. So there's two ways that transportation is paid for and that ownership transfers, and they're directly connected. We have two things, one called FOB shipping point, one called FOB destination. FOB means freight on board. I'm going to write that up here for you, just so you can hear the squeakiness again. Pink doesn't show up very well. I'm going to use a different color. FOB equals freight on board. Okay, so let me explain this to you. Transportation costs and ownership transfer is important for several reasons. Freight on board shipping point means that transfer of ownership for those goods goes from the seller to the buyer when it leaves the shipping point. So if I order bicycles from Schwinn manufacturer, at the moment, if it's FOB shipping point, I, the owner of the bike shop, both pay for the shipping and own the bikes the moment they leave the Schwinn factory. So there's a couple of important points that I want to bring up here. For one thing, they're my bikes. I have paid for them, and I have to pay for the shipping. And second, because it's FOB shipping point, so they become the owner, or the owner of the store owns them when they leave the factory. It means I need to make sure that that merchandise is insured while in transit. I also need to make sure that it shows up in my inventory on my books as soon as it leaves the shipping point. If it's freight on board destination, that means that it does not belong to the store, my bike store, until it reaches me. So ownership transfers when the goods are delivered to me. And on FOB destination, the shipper, the company that it's coming from, both pay the shipping cost and both own it until it gets to me. So they also have to make sure it's insured until it gets to the buyer, the destination, to my bike shop. So if I am the buyer and I pay the transportation, the journal entry is merchandise inventory, cash, because I paid for it. If I am the shipper and I pay the shipping, it's debit and expense, which is delivery expense, and credit cash. So remember, FOB shipping point and FOB destination. All right. Transportation costs, we just went through those. Merchandise inventory cash. Since freight terms were FOB shipping point, it meant Z-Mart owned them from the moment they left the dock of the manufacturing company. It becomes part of the cost of merchandise, debit merchandise, credit cash. So if you want to look at the complete list of accounting for merchandise, this is what it looks like. Invoice, cost, of merchandise, less purchase discounts received, less purchase returns and allowances. Remember that purchase discounts received is terms for purchase. Discounts, returns, and allowances are either things you returned or buying allowances you get. You add the cost of transportation, and then you have the total net cost of merchandise purchases. All right, we're going to do a problem here. So, as you can see, the problem is we purchased 125 units of a product at $4. Terms of sale are $210 net 30. FOB shipping point, the invoice is dated October 1st. On October 3rd, we paid $30 cash for freight charges from UPS for the October 1st purchase. October 2nd, we returned 50 defective units from the October 1 purchase and received full credit. And on October 11th, we paid the amount due from the October 1st purchase, less the return on October 2nd. 7th, return on October 7th. All right, here we go. First, we're going to do the journal entries and the T accounts. On October 1, it says that we purchased merchandise, 125 units at $4. So we're going to debit merchandise inventory. That is an asset. Debit of $500. And we're going to credit accounts payable. That is a liability account. And we're going to credit it for $500. Now notice, and it's just customary that we put the debit first. The debit is to the far left. We're going to indent the credit. We put it second, we indent it. Debit on the left, credit on the right. And our explanation is we purchased inventory. Terms, 210 net 30. Okay, so the next step, on October 3rd, we paid cash for freight charges from UPS. So we know that that is included in the cost of our merchandise. October 3rd, merchandise inventory. Was $30. Cash, $30. Notice I debited merchandise inventory, an asset account, and increased it by $30. I credited cash for $30, and we paid freight for inventory. On October 7th, we returned 50 defective units from the October 1 purchase and received full credit. So we're just going to write that down. On October 7th, we're going to debit accounts payable. It's a liability account that we're decreasing. So we were going to decrease it by $200. And we're also going to decrease our merchandise inventory. Remember that merchandise is an asset account. And we're going to decrease the merchandise inventory by $200. And we returned returned inventory $50 times $4 each. All right, and then on the last day of our terms, On October 11th, we paid the accounts payable which is now $300. It was $500 less $200. And we reduced merchandise inventory by $6 because we got a 2% terms on this, and we paid out cash for $294. Paid purchase of 10/1. This one right here, October 1. So that's what it would look like. If we add up, if we put up the T accounts and we have a merchandise inventory, I hope you can still see this. Merchandise. We have cash. That student is right. That is an awful sound. And we have accounts payable. Okay, so we start this out posting these. On the first, we debited merchandise for $500 on the first, and we credited accounts payable for $500. You always post a connecting number to connect this back to your journal. This is what your chronological journal entries would look like. And then when you take these chronological journal entries, you move them to your ledger accounts. Just for ease of use in class, we post to a T account. Back when I first started accounting, we had a big ledger book, and it had each of our separate accounts in it, and it had its own page and its own number. And now it's all done by computer, but these T accounts just represent those separate accounts in the ledger book. So it's for ease of use in the classroom. Okay, on the 3rd, we added $30 to our merchandise inventory for the freight, and we deducted $30 from cash where we pay it. So we've posted this one, and we've posted this one. On October 7th, we returned $200 in inventory, and we reduced our accounts payable by $200. 7th. So we have posted that one. And October 11th, we paid off this. And we reduced $6 from the merchandise inventory because we got a discount on the 11th. And we reduced our cash by $294 on the 11th. So now we have posted that one. So that is how it looks in your journal entry. So now we have a zero balance in our accounts payable. We have reduced our cash account by $314, and our merchandise is now worth $530, $530. We subtract 206, so it is worth $324, I believe. If we take the 530 minus 200 is 330, minus 6 is 324. So keep in mind that we increase asset accounts with a debit, we decrease them with a credit, just the opposite for liability accounts. And I want to move on and do this problem in the same way, except in this problem we are not going to take the purchase return. So we're not going to pay this until the 31st. So let's just see what happens when we don't pay this on time. And okay, so same order, everything's the same. We purchased the inventory, we paid cash for the freight, we returned $200, but we did not pay it within the discount period. So this is what it looks like. On October 31st, we still have the accounts payable for $300, but we pay out $300 in cash. For this time, it wasn't a huge amount because it was just $6. But what if the merchandise, we paid more for it, so it's now $330 instead of $324. This is still zero. What if those purchases were $30 million instead of $300? It would make a big difference. So companies really make a whole lot more money, save a whole lot more money if they'll be careful about paying their invoices in time to get those terms on all of their purchases. All right, let me get this board erased. So we talked about buying merchandise. As you know, companies usually have more than one product, so they're purchasing a lot of stuff. It's coming in at all different times. Most companies do have computerized systems now, so they keep a perpetual inventory system. Some companies still use periodic. I would say probably car companies or maybe airplane companies that have a lot. Even they probably have their inventory online, but they're going to do specific identification with each item as opposed to just having a bulk amount. This is the hardest board to receive or to erase. I really enjoy teaching on this so I can give you some kind of a video, especially for the online classes, but this board is really hard to erase. Let me see if this water helps. Sorry, I can't shut down the system while I'm doing this, but that would require I have the knowledge of how to do that. Oh my, much easier. But smeary, ooh, what a mess. All right, now I'm gonna have to find a different cloth and wipe it again. Hello. Okay, so that didn't work out so well. It just made it smeary and messy, but can't help it. Just like in the classroom, when the instructor can't quite get it to work that day. It's just one of those days. All right. So we know what happens when the merchandise comes in. We know how that it is accounted for when it comes in. But what happens when we sell it? Well, we have to make two separate recordings. One is the recording of where it's sold to the customer, and the other one is a recording of how we take it out of our inventory. So you have to make two sets of entries when merchandise is sold. Not confusing, but just an extra step that you have to do just to account for two things. One is the money that you have gotten from the customer, and the other is taking the inventory out of your system. So if Z-Mart sold $2,400 of merchandise on credit, the merchandise has a cost basis of $1,600 to your company. Now, in Chapter 5, we will learn how companies calculate that cost basis. So I'm just going to give you a brief introduction here to how it's done, and then we'll learn more about that in Chapter 5 next week. Okay, an entry to record the revenue and an entry to record the cost. So we have accounts receivable for $2,400 where we sold the merchandise and they're going to pay us later. And then we have, and that's a debit because accounts receivable is an asset. And the credit is sales revenue. And with the sales revenue, it is a revenue account, so it's a credit. And the other entry to record the cost is to debit cost of goods sold, which is a sales expense account, and credit merchandise inventory because we have sold the inventory, so we take it out of that account. So just the opposite of when we were the purchaser, we're going to give terms, discounts, and allowances to the people who buy things from us. So if we sell to someone and our terms to them are $210 net $30, so the day we sell it, we have a debit to accounts receivable and a credit to sales revenue. If the account was paid in full within the 60-day period, $210 net $60 were our terms to someone else, then we get cash for $1,000 and we receive accounts receivable for $1,000. If they pay it within the 10 days for our terms, on the 22nd, we get cash of $980 and a sales discount of $20, and we still give the credit of the full $1,000 to accounts receivable to clear that out of our asset account. So sales returns and allowances usually involve a dissatisfied customer. So sometimes sales returns refer to merchandise that customers return after a sale. Sometimes it refers to that discount we're going to give them so they'll keep the merchandise. So let's go back and talk about that same transaction where we sold $2,400 of merchandise that had cost our company $1,600. Let's assume that the customer returns part of that merchandise and the return items sell for $800 and cost $600. So sales return and allowances, credit accounts receivable because we're not going to get this $800, and the merchandise returned is returned into our inventory. It's $600 worth of merchandise. Now, the sale was for $800, but the merchandise cost us $600 because it's that profit between what we pay for the inventory and what we sell it for is how stores make a profit. This is a sales return and allowance. It's the one where the $800 of merchandise Z-Mart sold on November 3rd is defective, but the buyer decides to keep it. So we give them a $100 price reduction. And in that case, we debit sales returns and allowances for $100. We credit accounts receivable. So sales returns and allowance is a contra revenue account. It's an account that is would be subtracted from our inventory account, in this situation from our accounts receivable account. A contra account means just in opposition to, contra to. So if you have a revenue account for sales, but sales return and allowance subtract from it, then it's a contra account. All right, I'm going to run through one last problem with you, and then we just have a little bit more work to do today. And oh my goodness, this has been a long one. Well, I guess I'll just run through this real quick. Let me see if it's not on your screen. So, sold 500 units of merchandise to a customer for $14 per unit under credit terms of $210 net $30. FOB shipping point, and the invoice is dated June 1st. The merchandise had cost $10 per unit, and the customer returns 20 units because these did not fit the customer's needs. All right, journal entry 1. June 1, accounts receivable. It's an asset account, remember? Accounts receivable, $7,000. And sales revenue. Companies will call it a couple of different things, of 7,000. Remember that when you do a journal entry, the debit always has to equal the credit. So we sold 500 units at $14. Perfect. On June 1st, we have to make that second entry that I was telling you about, where we have to account for the merchandise. June 1. So we're going to debit cost of goods sold. For $5,000. And we're going, because that's how much the merchandise cost us. It's $5,000 to record inventory sold. Remember in chapter 5, I'll tell you how we know what this cost of goods is. On June 7th, they returned 20 items. June 7, sales returns and allowance. Sales returns and allowance is a contra sales revenue account. So sales revenue is a credit, a contra account, and it's $280. And the credit is accounts receivable because they no longer owe us that money. $280. So we're going to say inventory returns. Love that squeak. From June 1 sale. And now on June 7th, we're going to receive money, or we'll say on June 30th, we received money for this. And we are going to get cash. And we are going to credit accounts receivable. Now, they're outside our discount period. We didn't give them a discount period. So we know that we had accounts receivable for $7,000, and from the first, and we know that we reduced it by $280 on the 7th. So the cash we're going to receive is $6,720. And we're going to zero out this accounts receivable account, the $6,720. The 30th. All right, so now you know a lot more about inventory and merchandising than you knew before. I want you to go on and I want you to look at two different things on your own so we can get you out of the class for today or off the video. One is the adjusting entries, and it's the next slide. Okay, well, it's not a slide. So I will actually bring this up on chapter 5. I want to get done with this video today, so you're not, you're almost an hour at this point. So watch it in a couple of sessions, I hope. I hope you've had a good day, and be sure to text or email if you have any questions. Thank you and have a good day.